Hey, this is Sasha. I want to thank you so much for joining me in today's video. What we're going to do is we're going to cover what most people do wrong when it comes to trading weeklies and kind of how they approach it and how really you should think about when approaching weeklies. Now, I'm doing some of these videos to give you some insight as we get into some of the courses that we have coming up, which we have a brand new weeklies course that's specific to trading weeklies. So that comes out August 28th. And if you go ahead and grab the course, you can go to our website, tradersfly.com, to check it out. This course is already 20 hours long, and I'm keep adding some new video material in there. But if you want to go ahead and get it, you'll get a 20% off here by buying it early. You can even get it right now. But we continue to just add some more things because there's some work to be done in the back end right now for this. But this it's got 55 videos and 20 hours of material, so you'll save $100 by getting it a little bit early. Now, looking at this, we've got a lot of examples, and you can see we can trade iron condors, butterflies, calendars, diagonal, 0 to 5 DTE verticals, and much more. So a lot of people, when they go into trading weeklies, they kind of construct it in a bad way. And the reason I know that is because I look at a lot of different accounts. I mean, the majority of the things that I do is working with people. Is I go in and do coaching sessions, and I even work with people for 3 to 6 months. But I look at people's accounts, and when I look at people's accounts, I see a lot of things that go right and a lot of things that go wrong. And in this video, I want to share with you some of the things that I see that is kind of wrong with trading weeklies. So when you go in and I see these accounts, a lot of times when we look at kind of like a portfolio, let's just say somebody's trading with $10,000, what they'll do is they'll put like $8,000 into trading weeklies or that weekly, and they'll put it all in one strategy. Okay, whether it's iron condor, whether it's verticals, it's like one strategy. They do it all in one day. Okay, they do it all at one strike price. Okay, so what you're doing is you're concentrating your risk in this one little spot. So if this is your portfolio, they concentrate the risk here rather than spreading the risk in different spots all over the place. Okay, what you want to do is have a lot of different areas where you've got risk all over the place, not just in one spot. That way, if any one of these goes bad, the rest of these, let's say 20 of them, are still good. So maybe instead of 20, you got 19 that are still good, but one of them is bad, right? And really, that's not the case. You're not going to have like 19 winners and one loser. You might have, let's say, 14 winners and maybe 6 losers. Who knows? Maybe it's the other way. But the point is it's not all like one-sided, one trade, one time. And that's what I often see is when people go in and we go into, like, let's say a trading platform. So let's say we go right here and we'll go into something like this. And I want to go and do a trade on, let's go with Twitter, pretty popular. Okay, so let's go and do a bunch of verticals. So what they'll do is they'll say, hey, let me sell some verticals. And they might go 10 days, they might go 17 days, whatever the case is. But let's say we go right here, 10 days. And we'll sell a bunch of these verticals. And then what they'll do is they'll rack these up and they'll go in and say, okay, well, let me sell like 60 of these because I can afford about 60 of them. And then when they put that trade on, that's like 90% of their account. And that's a huge issue and problem because you're using like 11 grand of your capital. Let's say you got a 12 grand account to make 900. And sometimes it works, sometimes it doesn't. But if it doesn't, that's where the issue lies. And they concentrate all that risk on one day at one time, creating a big, big problem. Okay. Now, how should it look? What's the better alternative or approach? Well, something like this. I've got some stuff in butterflies. Okay. So I've got a bunch of, trades here, maybe in butterflies. I got some others in verticals. Okay. So I might have a bunch of trades over there. I throw a few iron condors in there. I've got some calendars in there. So all of these trades kind of create a composite of my total portfolio, but I don't concentrate like everything in this one single trade. It's a bunch of little trades where, some of these are, okay, I've got some winner, 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 loser, loser, winner, loser, winner, loser, loser, winner, winner. It's all over the place, right? I don't have it all concentrated in one spot. And that's the big problem with a lot of people is they really just hone in and concentrate everything here. Boom, 10 grand, 8 of it in that thing one time. That's it. And if it goes against you, it blows up and it's done and it's dead. And then they panic because it's like, hey, I put a lot of money in this. I really believed in it. I really loved it. And that may be, look, it maybe sounds great. Maybe there's a big time CEO that's behind it. You might believe in them, you trust them. But at the end of the day, it comes down to spreading your money and capital. And that's what you want to do here is spread your money in different spots and in different areas. So that's what we want to do is we want to get to that point where we're spreading things out in different areas. So if you got a $10,000 account, put $1,000 in different strategies. So you could do 10 of these, right? Even if you did $2,000 each, so you got 1, 2, 3, 4, 5. So even if you did $2,000 each, okay, now you'd be up to your $10,000, but you could do an iron condor, you could do some verticals, you could do some calendars, you could do some butterflies, you could do some diagonals, you could do a mix of things. And now you've got a much more diversified kind of portfolio or mix. But that's, again, just a smaller fraction to your total portfolio. And even then, weeklies might only be a tiny bit of that portfolio in total. And then other stuff, you might have longer investments or longer duration trades. So remember, there's a bigger breakdown and a bigger picture to this than just doing things all at one stock, all at one time, at one expiration on one day. So don't make that mistake. It's a lot of these things that I see all the time when I deal with people and work with them on the coaching and mentoring. And when I see accounts, when people call me in a panic as well, and I look at accounts, we oversee it. A lot of that, many mistakes is just putting it all in at once, at one time, in any given point. So be careful. That's what we've got this course all about. So if you're interested in this class, in this course, go ahead and check out our website. Just go to tradersfly.com. And then when you go to tradersfly.com, you'll see it right there towards so you scroll towards the middle of the page. And then what you'll be able to do is go ahead and click this, and that'll take you to our courses website where you can purchase this. And as we continue to expand and add trade examples, you'll be able to grab this class for a little bit of a discount. It's all pre-recorded. You get $100 off, so it'll be $399 right now. And once that discount's over, it's done, right? It's over. So once the option expires, it's over. So in the same case here, once the coupon expires, it's done. There's nothing to put in. You just hit the get it started button, and then you'll get the coupon will already be applied. So anyway, I hope that helps, gives you some insight. Truly appreciate you joining me here in this video. If you have any questions, please do reach out. But I wanted to share with you some insight as far as looking at a bigger portfolio and understanding where weeklies fall into play compared to doing regular trades or longer duration trades. So it's important you recognize that it's not just, hey, a single trade at one point at one time, even though it may seem that way if you're looking at different videos online, and you might think, oh, well, I could make $7,000 with this one trade or $5,000 with that one trade. But it's really a smarter approach is to spread your money out, spread your money around, spread the risk. And that's much better than, putting it all in one spot at one time. All right. Thanks for joining me, and I'll see you next time.